Great. Thank you very much. Welcome, everyone, to our discussion on what's been going on with the IRS over the last 6 months or so. The IRS has been very busy issuing guidance under the Tax Cuts and Jobs Act, but that's not all that's been happening. So we want to catch you up on some other important areas and highlight some sections today that we think will be of interest to you. So, David, let's go to our presenters. Speaking today, we have Tom Cryan, David McCallum, and Ann Oliver, and I'll be your host today. This is the team. They have experience working inside the IRS, inside Chief Counsel's office, inside the Department of Justice, and also outside on the side of goodness and light, serving clients, helping them to navigate a number of different issues within the IRS, resolve examinations, resolve penalty issues, and other situations. Anytime you're dealing with a large government agency, it is certainly helpful to have people who are in the know. So they're going to bring their expertise to us today. Let's talk about what our agenda is going to cover. So first, Tom will introduce us to what's been happening with the IRS and particularly the Appeals Division. Then David will talk about what's been going on and new announcements of issues that the large business and international divisions believes are good sources for examinations. And Ann will talk to us on penalties and what's changed, particularly under the Tax Cuts and Jobs Act. And then there's a little bit of international issues that we'll address at the end. So with that, let's go ahead and turn it over to Tom to talk to us about what has been going on with the IRS. Tom?
Yes, I think you'll find some very interesting developments at IRS, both in exams and appeals. And as we look at the first slide on exams, and I was surprised to hear this, but they're going to go ahead and hire a lot of people. Large Business and International, which audits taxpayers with over 10 million in assets, is hiring 500 new employees. And these basically are the revenue agents, the engineers that go out and do valuations, and the economists that work on transfer pricing cases and other valuation type issues. They have said that they're going to hire some now, November, December, or November's over with, but they've taken applications in November, and they're going to start hiring as soon as possible, and they're going to hire more in the spring. Small business and self-employed, which is basically the other field unit that does audits, is going to add 850 revenue agents and 725 revenue officers. Revenue officers are the ones that do the actual collection process. Once there's assessment, they go out into the field, they seize assets, they take offers and compromise, they deal with installment agreements, etc. So that's certainly going to help them process these quicker. Now, these additions were long needed. Over the last 10 years, there have been very few hires. They're way down in the numbers, as we indicated in our last webinar in June. So all of these are very needed. The only thing I'll say is there's a long time between bringing somebody onto IRS and actually doing an audit. They have to be trained. A lot of them start their training by going out and working with experienced revenue agents. Although there will be some people that come from accounting firms and law firms who do have some experience in that area. Let's now take a look at the next slide. And most of you have probably heard that Charles Redick has been sworn in as the commissioner. He's a well-known tax attorney from the West Coast. He's got a little over 4 years left on the term. And he is, as you would expect, he wants to implement the Tax Cuts and Jobs Act. Everybody wants that done. Continue to get out more guidance, and they have put out quite a bit of guidance. Upgrade IRS's technology. Now, I understand from talking to some people that have worked with Mr. Redick recently when he came on board, his biggest fear is the fear of all commissioners that the computer system will break down during filing season. As we know, we had a temporary breakdown last April 16th. These systems are very old. Some of them are 30 or 40 years old and are very difficult to maintain and to deal with the complexity of today's returns. So that's his big goal. He needs money from Congress to do that. we'll see if he gets it. And again, provide high quality, personalized level of taxpayer service. One would expect that. But again, somebody coming in from the outside normally will not accept the status quo. He'll want to improve things, and he'll want to find out why he can't improve things. So I expect we'll see a lot of things coming with Mr. Redick, the new IRS commissioner. The next slide, we're going to talk about IRSIC. Now, IRSIC is the Internal Revenue Service Advisory Council. They're third-party tax practitioners, and they make recommendations on a yearly basis. They meet, I think, at least twice a year with the commissioner and his staff, and they discuss problems. They're basically one of the ways IRS communicates with the outside, although they have a different role than some of the other different communications, because they actually have funding. They come in, funding in the sense of travel, per diem, and they make a recommendation. And of course, the first recommendation, which has been asked for in a long time, I think it's been asked for not only here, but by the taxpayer advocate, by members of Congress, certainly by Treasury and the Commissioner, adequate funding. Now, in order to accomplish the fourth bullet there, improve real-time communications in exigent circumstances, they need the funding. They need additional staff to deal with tax practitioners when things go wrong. They need new hardware and software, new systems to make that happen. So those two things go hand in hand. The pre-file program, I'm not going to talk about that other than they're trying to improve it. The third bullet, and for those that don't know, IRS has lost a number of cases where they tried to enforce their rules against people who are not authorized to practice before the IRS. So we have the CPAs, the attorneys, the enrolled agents. They have authority over them because they actually practice before the IRS. The courts have said that merely filing a return is not practice before the IRS, and I'm not surprised that that happened, although IRS had a lot of history built up that they could do that, but legislatively, the statute didn't work for them. Just because you prepare a return doesn't mean you're practicing before the IRS. So it'll be interesting to see what, if anything, comes of this, but of course, these are four important recommendations. With that, let's go on to, which I find the most interesting of the topics today, is IRS Appeals. And the reason I find it interesting is sort of they've done a 180-degree about-face in the last 2 years. When they first announced sometime back in 2016 that they were basically doing away with in-person meetings for field audit cases, even the large ones from LB&I, everybody was really surprised. There was a lot of complaints, and the acting, or I shouldn't say the acting, she was the chief of appeals. She claimed that most of their good work was done by phone anyway, and they were just putting into practice what was already going on. And they had very limited exceptions, which I won't go into, where they would have face-to-face meetings based on requests by the taxpayers in these large audit cases. Well, they turned that around in October with this interim guidance revoking the earlier limitations. And basically they said, if you wanted a face-to-face meeting for a field audit, just ask and we'll try and accommodate you. Then just 2 weeks ago, they came out with a new announcement. Again, it's an interim policy. It's not in the Internal Revenue Manual, that they're now going to hold face-to-face meetings or in-person meetings, as they call them, with correspondence audits, ones that, originated basically in the service center. And there's certain problems with that because there's no way, if the case is assigned to an appeals officer at the service center, they call that campus appeals, where they can meet. They don't have the facilities to meet, but they're going to try and accommodate requests even for those type of cases by either allowing those campus appeals people to go to a federal building when it's appropriate. So you got a service center in Philadelphia and you got federal building in Philadelphia. That's easy to do. It's more difficult in some of the other locations, but that's one of their plans. The other plan would be to transfer these cases to an appeals office that they could have a face-to-face meeting. Now, they have made it very clear that they'll try and make a reasonable accommodation for the place requested for this face-to-face meeting, but they have to take into account the availability of the appeals officer. In other words, what is their workloads in the area requested, and is this a subject matter that requires an expert appeals officer? We know from experience that if you're in the international area, they have appeals officers that specialize in international. So you would have to take that into account. So you may want a meeting in Charlotte, but they don't have an international person anywhere in North Carolina, so you may have to go to Atlanta where we know they have appeals officers. Now, you need to be assertive, and I would say you need this in-person meeting request up front. I would put it right in the protest or the cover letter to the protest. You need to be assertive. Appeals officers will know these new rules, but they will not come out and tell you necessarily that you're entitled to these. All depends on the particular appeals officer. Many appeals officers would rather do them by phone. It's easier, it's quicker. They don't have to deal face to face, which some don't mind, some like dealing, but some do not. Now, video conferences, they've been used in the past, and again, that's another area where they may try and accommodate you, so at least you're looking at the person in dealing with them. Let's go on to another area that's an evolving area in appeals, and that has to do with exams' role in appeals conferences. Used to be in large LB&I cases, the only time you would see them would be if there was going to be a pre-conference meeting where they wanted to present their case to the appeals officer, answer the appeals officer's questions, and because of the ex parte rules, they couldn't do it without the taxpayer being present. Either it was a phone conversation or an in-person conversation. They then started expanding that in their appeals team case leader cases, and they would say, well, not only are they going to make the presentation, but they're going to sit there and we're going to go through the issues and they're going to help narrow the factual and legal issues on each issue. So we know what exams position is and we know what the taxpayer's position is, and let's see where there's agreement, where there's disagreement. Now, the problem with that is it seemed that some of these exam people were hanging around through the negotiations, and the taxpayers were sort of left with the impression they didn't have any choice. Well, appeals leadership says they do have a choice. They can ask them to leave once you get into the negotiations. Only problem is that the appeals officer decides when you're into the negotiation phase. The other thing that may happen either before exams comes to this meeting or at the meeting, the appeals officer may say, well, I want to do rapid appeals process. And that's basically where the appeals officer, he doesn't make the decision on his own. He mediates between exams and the taxpayer and the representative on trying to resolve the issue. And personally, I would resist that. I don't like rapid appeals. If you wanted a rapid appeals type process with mediation, you could ask for fast track early on. So my personal view is I would not accede to rapid appeals process. And that may come up initially when the appeals officer calls you or your representative and says, hey, I want to come in, let's do rapid appeals. So again, it's your decision, but I think there's a lot of downside to it. Let's go to the final slide on appeals. And just to, again, make the point, LB&I always has been involved in at least making a presentation on their case, either over the phone or in person. We see some indication at SBSE may do that in larger cases. Appeals does have the authority to allow them to come in and, make a presentation up front. And again, if they go to rapid appeals, they can bring the revenue agents and manager in from SB&SE. With that, I'm going to stop here and I'm going to turn it over to David, who's going to do the next presentation.
Great, and I think, David, we're up to our first polling questions. So, Chrissy, if you want to open up that polling question. So the first question is, have you or your company been examined in the last 3 years? And this just gives us an idea of, among the participants today, what your experience has been and how active the IRS has been with the businesses and individuals in our footprint and our listening audience. So go ahead and take a roll at that, and then we will move to David, who's going to talk to us about what's happening with large business and international division.
Okay, thank you, Sarah. Again, LB&I is kind of shifting their focus of how they are conducting examinations. And in January of 17, they rolled out these compliance campaigns that they've started. The initial rollout had 13 campaigns. There were 8 webinars that were hosted by some of the larger accounting firms and, some of the preeminent law firms and even some other organizations, where basically the IRS was pitching this new compliance campaign approach. And the idea here is the IRS wants to, harness their combined intellect to, increase the efficiency of audits, not necessarily have more audits, but increase the efficiency of audits. And it's a fundamental change to their audit selection process. It's kind of a shift from high risk taxpayers to high risk issues. That remains to be seen whether that fundamental change is actually going to take place. I would say some practitioners probably still believe this is just a modified version of the old Tier 1, Tier 2 audit system. And then another integral piece that they kind of push with this initial release of the campaigns back in January of 17 is that there's going to be a feedback loop. It is kind of still unclear. What is that going to look like? Is it going to be formal? Is it going to be informal? Right now, any of that feedback has been informal. There is no formal feedback loop at this point, but hopefully we'll see some actual progress there in the near term. So again, you had 13 campaigns in January of 17, you had 11 more in November. Probably January of 11 more in November of then, and then you had of 17, and then you had 5 in March, and you saw a lot of international and tax and pass-through focus early on, international tax focus, pass-through focus early on, and then non-resident aliens in May. And then we had some batches, and these are the ones we're going to kind of dive into more details in the upcoming slides. So you've got 5 additional campaigns in July, a lot of S corporation focus and international focus. You had 5 more in September with your 199 DPAD refund claim since it got repealed by the Tax Cuts and Jobs Act, syndicated conservation easements, and some more international tax issues. And then 5 more in October. So we're up to 50 campaigns in 24 months total, and those campaigns have resulted in, you got 25 domestic and 25 international. So again, international is a huge focus of these campaigns. Takeaways from the campaigns really that have been released at this point is IRS is going to really try to focus on high-risk issues instead of high-risk taxpayers. I think we'll see those things kind of dovetail between each other. Your high-risk taxpayers are going to be pursuing 2 or 3 high-risk issues. International focus is prime. It's going to be a collaborative model of enforcement. The IRS has this idea that it's going to be this collaborative model of enforcement with taxpayers providing a lot of feedback. That hasn't really manifested yet. Then there's a lot of training and IRS guidance that has been taking place internally, which they've generally been releasing to the public at large. They've created multiple practice units for several of these campaigns so far, and every time they've issued a practice notice that it has been issued to the public, usually a couple weeks after it's been issued internally. The other thing I think you'll kind of see with a lot of these campaigns is LB&I is starting to scrutinize the mid-market a little bit more. They are not just going after the Fortune 500 and Fortune 1000 companies. A lot of these campaigns have more scrutiny applied to the mid-market or are directly focused on the mid-market. I think the last thing you'll see is there's going to be a resource shift if the Tax Cuts and Jobs Act implementation permits the LB&I to do this, but a resource shift to taxpayers with campaign issues instead of taxpayers who are under audit for other issues. Taking a deeper dive into some of these, I'm not going to talk all of these because then I'll eat up the rest of the presentation time. But again, one of the larger issues that's definitely one of those that targets the mid-market is the S corporation distributions campaign. So the IRS has 3 common reporting issues that give them headaches that this campaign is focused on. And the first one is when an S corporation fails to report gain upon the distribution of appreciated property to a shareholder. So that's one of the issues they're going to be targeting through issue-based exams. They've updated some of the forms to require you to report more, and then more outreach from the IRS, whether they're doing webinars on their own or directly interacting with practitioners. Second issue that the IRS is worried about for S corporation distributions is when the S corporation fails to determine that a distribution, whether a cash distribution or property distribution, is properly taxable as dividend. So should the distribution have been treated as dividend? And then the third issue that is the other focus of this campaign is when a shareholder fails to report non-dividend distributions in excess of their stock basis that are subject to taxation. So you've got 2, kind of reporting issues that are at the entity level, at the S corporation level, and then one that's at the shareholder level that the IRS is going to be focusing on in this campaign. And obviously, the pass-through entities practice area, one of the subject matter practice areas for LB&I is going to be in charge of this campaign. The other campaign I wanted to note of these that got released in July is the virtual currency campaign. And so that directly goes to your Bitcoin, your Ethereum, your Coinbase, all of that virtual currency. The IRS has a campaign on this now, and it is basically the IRS in Notice 2014-21 stated that virtual currency is property for federal tax purposes, and transactions need to be reported on returns. Sell, buy, exchange transactions all need to be reported on the return. Again, the IRS is also stated in this campaign that they're still willing to receive feedback from practitioners and the public at large about how this should be treated. But right now, the IRS is treating these transactions as property that needs to be reported on the return as property transactions. Again, impacts of tax reform here is that if you're exchanging these virtual currencies for another virtual currency, if you're exchanging Bitcoin for Ethereum, then you maybe could have treated it as a like-kind exchange in 2017, but because the Tax Cuts and Jobs Act, that is no longer a 1031 exchange, and so you're going to have to report the transaction, the gains and losses on those transactions. So this virtual currency campaign could have broad impact. Kind of the last point on this piece is that the IRS specifically stated in this campaign that there's going to be no sort of virtual currency voluntary disclosure program. They had success in the Coinbase case with the John Doe summons. They got plenty of information, and I think they feel they can do that again. So there's going to be no sort of virtual currency voluntary disclosure program. It's going to be a campaign. It's going to be outreach. It's going to be examinations. And there's not going to be a voluntary disclosure program. On the September of 2018 campaigns, kind of want to focus on this top 2 up there. That first one is really just the IRS saying, hey, taxpayers, we know that DPAD, once the domestic production activities actually got repealed going forward in Tax Cuts and Jobs Act, and we know some of you are going to try to utilize it to the last and greatest extent possible, and their IRS is fully expecting some amended returns for 15, 16, 17 taxable years with big old domestic production activity deduction on them. This campaign is IRS letting taxpayers know that they are anticipating that, and they want to make sure that taxpayers are complying with the domestic production activity deduction, meeting the requirements, calculating it correctly, using the correct simplified method if they're eligible for it. So I would expect if you're going to file a couple of amended returns with large domestic production activities deductions on it, you may get picked up for examination because of this campaign, or at least that initial claim is going to be reviewed. That amended return is going to be reviewed with a little bit more scrutiny instead of just processed through the ordinary batch. And then you may get caught up in an issue-based exam. And this is also one of those campaigns that will eventually dovetail and go away once the kind of assessment statute has run on most of these taxable years, and now since DPAD's repealed. So I would expect this campaign to probably go away in 2 or 3 years. it'll be hot and heavy early on. Secondly, syndicated conservation easements. Again, in Notice 2017-10, the IRS made syndicated easements a listed transaction requiring disclosure statements by pretty much every party involved in the transaction, having to report something. And basically, the IRS has kind of defined syndicated easement as if you receive promotional material, offering investors through a pass-through entity the possibility of a charitable contribution deduction via a conservation easement that exceeds 2.5 times the amount of the investment. That or substantially similar transactions are kind of what the IRS defines syndicated conservation easement transactions. So the list of transactions, two main things here. IRS is, wants to ensure consistent treatment across substantially similar taxpayers and accurate fair market values. The IRS has fought these conservation easement cases very hard. They've had a lot of success in tax court in particular on these cases, particularly at substantiation issues, but they've had some success on the valuation front as well. So I'm not surprised that this is a campaign, and it will probably stick around for a long time. So if you have one of those transactions, if you're going to do one of those transactions, be aware that it's a listed transaction now. You're going to have to disclose it. And now it's also an LB&I campaign. So the risk examination was high anyway, and it just got higher for these type of transactions. Finally, the October campaigns that were added, the individual foreign tax credit phase 2, again, this one is really about making sure that the credit available under Section 901 to kind of alleviate the double taxation if you have foreign source income is really just making sure that individuals are meeting the requirements of the statute, making sure they qualify for the foreign tax credit. There's a lot of, or at least the IRS perceives there's a lot of abuse here, and that taxpayers aren't really qualified for the credit and are getting a dollar-for-dollar offset. And the other one I wanted to focus on is the FATCA filing accuracy campaign. Like I said, FATCA is the Foreign Account Trust Compliance Act. It's been around since 2010. And it's really, its purpose was to detect, deter, and discourage offshore tax abuses through increased reporting, basically. IRS is worried that FATCA entities that have FATCA reporting obligations are not actually complying with those reporting obligations. So they're kind of focused on those entities. There's going to be a variety of treatment streams. So it's really, if you have FATCA reporting status, IRS is going to make sure you're doing it right. And if not, they may terminate that status, and you'd be in big trouble if you're one of those entities. And if you are related to one of those entities, be in trouble as well. And finally, WOTC has been accepted into the Industry Issue Resolution Program. And WOTC is basically the Worker Opportunity Tax Credit, but part of the problem with WOTC is it took you forever to get certified for WOTC. So then you end up having to file multiple amended returns claiming large WOTC credits. And the IRS was like, whoa, we've got 2 or 3 amended returns with big credits on them. Let's examine those as well, not realizing that the main reason there had to be multiple amended returns is because the IRS took forever to process your WOTC certification. So basically, WOTC is in the Industry Issue Resolution Program to figure out if they can streamline the WOTC certification process and streamline audits so there's better, more efficient compliance. Taxpayers don't even bother, taxpayers will actually pursue the WOTC credit because it's administratively easier going forward. Right now, some taxpayers who are eligible for WOTC don't even bother to go through the process and claim it because it's such a pain on the administrative side of the IRS. So IRS is trying to alleviate some of those problems. They realize it's an issue. So that's kind of one of these unique campaigns that's an Industry Issue Resolution Program, and hopefully that works out for everybody. Now I think we're on to our second polling question.
Yes, that's right. Thank you, David. So our second polling question, David just walked us through the newest campaigns that were issued here in late 2018. So could one of the or more of these compliance campaigns apply to you or your company, whether you fall into the large business and international or into the SBSE, Small Business and Self-Employed Group, does one of these campaigns look like something that you should be interested in paying attention to? All right, I'll give you just another minute or two, and then we'll transition over to Ann Oliver. Ann is going to share with us about penalties and what the new rules are that came through in the Tax Cuts and Jobs Act in particular relative to penalties. That hasn't gotten a lot of attention yet, but we're going to give it some attention now. So Ann, I'll turn it over to you.
Great, thanks, Sarah. As Sarah mentioned, there was a big change with tax reform to one of the more common penalties. So we're going to take a look today at the accuracy-related penalty. First, I'm just going to highlight sort of the basis of the penalty before we get into what the change is, just to make sure everybody's on the same page. This is a relatively common penalty. You will see it a lot in exams. It's not a penalty that would be assessed when a return is originally filed by a taxpayer, because it relates to an underpayment of tax that was later determined, so something that was not reported by the taxpayer in the first instance. So usually it's called the accuracy-related penalty. Sometimes people will refer to it as an underpayment penalty or even just the 20% penalty. It's got a lot of different pieces. We're just going to talk about some of the bigger, more common ones. So as I said, it's a penalty that's equal to 20% of an underpayment of tax. And that underpayment has to be attributable to a specific thing. There's multiple listed in the statute. I pulled out some of the more common ones. So if you have an underpayment of a tax that is attributable to negligence or disregard of rules or regulations, that's one that sometimes we'll see. If there's an underpayment attributable to a substantial understatement of income tax, and that's the one we're going to focus on today. It could also be an underpayment that's attributable to a substantial valuation misstatement, an undisclosed foreign financial asset understatement, or about half a dozen other things. And so again, we're looking at the actual underpayment of tax that was a result of a position that a taxpayer took on a return, and then that position has been corrected by the IRS, later on audit. The penalty does not apply to any underpayment of tax that's attributable to something else. So let's say there was an underpayment that didn't qualify for any of these. It wasn't a substantial understatement, which we'll get into in a few minutes. It wasn't a result of negligence. It was a result of something else, possibly a keystroke error, something else. There would be no accuracy-related penalty on that. In order for this to apply, the IRS has to assert which one of these listed items, or again, the others that I didn't talk about today, which one they think gave rise to the underpayment. And if none of these apply, even if there is an underpayment, this penalty won't apply. The penalty can also only apply once. So let's say we had an underpayment of tax that was a result of both negligence and a substantial understatement. It would not be a 40% penalty with 20% for negligence and 20% for substantial understatement. You could have every single one of these reasons listed for an underpayment, but still only the 20% penalty is going to apply. So you don't stack it even if there's multiple reasons why the penalty could apply. Now, sometimes this penalty can go as high as 40% in certain circumstances, which we're not going to talk about because that's not the norm. The norm is the 20%. But just to make you aware of that, there are certain things that could lead to a 40% penalty on the underpayment of tax. So let's go to the next slide. Talk a little bit about what a substantial understatement is. So an understatement itself, whether substantial or not, is the difference between the amount of tax that was required to be reported on a return. So I usually refer to that as the correct amount of tax, right? So the actual amount of tax, the right amount that should have been reported, that was required to be reported, and the amount of tax that was actually reported. So if a taxpayer files a return and they say, I owe $100,000 of tax, that's the amount that was actually reported. That's on the return the taxpayer filed. If upon examination, it's determined that the taxpayer actually owes $150,000 of tax, that would be the amount that was required to be reported. That's the correct amount. You might have heard somebody mention in passing an amended return and how that applies in this situation. if a taxpayer files an amended return, it's treated as the amount of the amount of tax that was actually reported. So if you file an amended return before the IRS alerts you to the fact that something might be wrong with the return, it's considered a qualified amended return, and you will effectively get credit for that amount of tax that you've reported. So if there's an issue, and this is one of the more common questions we get, someone says, I've noticed that there's an error on my return. What do I have to do? You are not required ever to file an amended return. There is a statutory obligation to file an original return, whether you're an individual or a C Corp or some other kind of an entity. There is no statutory requirement to file an amended return. So if you find a mistake on your return, it's your decision as to whether or not you want to amend it. What I usually point out is the number one downside to not amending a return when you've discovered a mistake is that if the IRS catches that mistake, this penalty will apply. However, if you file an amended return, you fix it and you report it, then the amount of tax actually reported increases to the amount you reported later, and you wouldn't be subject to this penalty. And 20% can be a pretty steep penalty, so it's definitely something to consider. Okay, so the understatement is the difference between what you reported and what you should have reported. The understatement is substantial if it exceeds the greater of one of two things, either 10% of the tax that was required to be shown on the return, so the correct amount of tax, or $5,000. There are different thresholds for corporations, but this is sort of the standard individual threshold that we would look at. So let's go ahead to the next slide and take a look at an example. So here we've got the reported amount of tax. So you file your tax return and it says $90,000 of tax. Upon examination, it's determined that the correct amount of tax is $100,000. So that means your understatement is $10,000, the difference between the correct amount, $100,000, and the reported amount, $90,000. So in order for the understatement to be substantial, such that this penalty would apply, it's got to exceed the greater of either 10% of the tax that was required to be shown, which would be $10,000, or 10% of $100,000, or $5,000. So obviously $10,000 is the greater of the two, so your understatement has to exceed $10,000. Well, in this case, you got really lucky because your understatement was exactly $10,000. So this understatement would not be substantial for the purposes of this penalty. Now, if you remember back on one of the first slides, I talked about the different ways in which this penalty could apply, and one of them was negligence. Negligence does not have this kind of threshold like the substantial understatement does. So it is possible that you could still be hit in this situation here, even though there's no substantial understatement. You could still be hit with the accuracy-related penalty on negligence grounds. But if we're talking solely the substantial understatement piece, this is how the calculation would be done. And in this situation, you would not have a substantial understatement. So let's look at the next slide. This is a very similar example. All I did was change it by $1. So here, your reported amount of tax is $89,000 instead of $90,000, so just $1,000 less. Correct amount of tax remains the same. It was $100,000. So in this case, your understatement is $11,000. This obviously does exceed the greater of $10,000 or $5,000, so you have a substantial understatement. Now, I could have hammered the point home, I suppose, and made the understatement $10,000.01, which would have also exceeded $10,000, but it just shows you that you could have two situations that are very close, and one is going to be subject to the 20% penalty, and one is going to be subject to a 0% penalty because the accuracy-related penalty won't apply. So here, the penalty is going to be 20% of the understatement, and the understatement is the $11,000. So you're going to pay a 20% penalty on the $11,000 or $2,200 in this case. Now, again, if your understatement was only $10,000 and you were just under the threshold, you wouldn't have paid anything. Okay, so let's go to the next slide. So that sort of sets the ground for the general accuracy-related penalty standard. Okay, so now with Section 199 Cap A, there was an amendment to Section 6662, which is where the accuracy-related penalty lives. And this amendment now provides that in the case of any taxpayer who claims the deduction allowed under Section 199A, there is a substantial understatement of income tax if the amount of the understatement exceeds the greater of 5% of the tax required to be shown on the return, or $5,000. So before, the threshold and the general threshold for the accuracy-related penalty it was 10% of the tax required to be shown on the return, or $5,000. Now, what's important here, and what's kind of gave people some pause, is that this applies whether or not the Section 199A deduction gave rise to the understatement. So that means that if you have a taxpayer who claimed the 199A deduction, even if that calculation was 100% correct, but that taxpayer had an understatement due to something else, if it was an item of income that had been left off the return, or if it was another deduction having nothing to do with the 199A deduction, that understatement is still subject to this lower threshold test, this 5% of the tax required to be shown. And so it kind of opens up this penalty to anybody who claims the 199A deduction, even everybody who does it very carefully. And that part was a little bit shocking because while I think we can sort of appreciate Congress's desire to say, okay, we gave you this 199A deduction, but we don't want people to be, overzealous in claiming it. We want to be able to rein it in a little bit, which is common. With the R&D credits, there was a specific penalty that was enacted for refund claims that were overstated, which was sort of the downside to overstating, an R&D credit. This is supposed to be enacted as kind of the downside to overstating your 199A deduction, because if it's disallowed in part, that disallowance would generally generate an understatement. And so they're saying the threshold is lower. It's going to be easier to be hit with this 20% penalty. But the problem is it was not written to say that it's only if it's attributable to the 199A deduction that then that understatement is subject to this lower threshold. So I suppose it's always possible that the statute could be amended to narrow down its application, but right now that's how it is. So we've talked a lot about 199A and we'll continue to talk a lot about it, but just something to be aware of. This penalty in general is now going to have a much broader application. And I'm pretty sure that examiners are required to either assert this penalty or what you'll see a lot of times on exams is they'll send out an IDR or something else where they'll say to the taxpayer under exam, I'm proposing the accuracy-related penalty. Tell me why it shouldn't apply. And that's something that they do as a matter of course. So this isn't a penalty that only applies in certain circumstances. Pretty much every time you end up with an understatement on exam, or like I said, it doesn't have to be substantial because they could also argue negligence, you're going to see this penalty being asserted. Now with this lower threshold, I think we're going to be seeing it asserted even more. So it's even more important to sort of get our ducks in a row and to think about the ways to get out of this penalty, because I think we're going to see more of it. So let's flip really quickly to the next slide, which is just an example under Section 199A. So here I'm showing the reported amount of tax is $94,000, correct amount of tax is $100,000. So we have an understatement of only $6,000. Again, the understatement has to exceed the greater of either 5% of the tax required to be shown, or $5,000, or the same amount in this case. So here we have a substantial understatement. If you remember on the previous examples, when there was an understatement of only $10,000, they weren't hit with the penalty because they didn't meet the threshold, and it wasn't until they got to $11,000 that the penalty showed up. So this just sort of, makes it clear how this penalty is going to apply in more situations because the threshold is going to be lower. So let's go to the next slide. Now that I've scared everybody and told you that you're going to be seeing a lot more of this penalty, we're going to talk for just a minute about ways to get out of this penalty. So you can actually reduce the amount of the understatement. And again, the understatement amount is crucial because that's the part that either meets the threshold and makes it substantial or does not meet the threshold. And so that's the part that we need to be concerned about. And so the amount of the understatement can be reduced. And the understatement, even though we talk about it as sort of a global lump sum amount, it's really multiple things put together, right? So you could have multiple different items on your tax return that are adding up to create the understatement. And so even though we talk about it as the understatement, you can have different portions of it. And so the understatement is reduced for any of the portions where, and we've got two different things here. You can either have substantial authority for the treatment of the item that was understated, or if that item was adequately disclosed and there's reasonable basis for the treatment. We're not going to go into the adequate disclosure and reasonable basis, but just quickly, in case you've heard those terms before, that's talking about like filing a Form 8275 or 8275R, something like that, where you have disclosed what you're doing, and then you have a reasonable basis for that position. So we're just going to look really quickly at the substantial authority issue. It's important to note this reduction doesn't apply if any of the items are attributable to a tax shelter. There are special rules for those. Even if you have substantial authority, if it's a tax shelter, it doesn't matter. You can't get out of it. But one of the ways we could reduce this understatement is with substantial authority. So let's take a look at the next slide. This just kind of gives us the scale of authorities. So to understand where substantial authority is, so if we're going to say that there is the tax treatment that is a will, whereas it will be accepted, that is a greater than 95% chance that your position is correct. So it's very, very high. It's almost perfection. As a result, you don't see will positions very often. Then there's a should position, which is that the treatment of an item should be treated as correct. That's about greater than 70%. Then there's more likely than not, which is literally just anything over 50%. Like 50.2% will be more likely than not, as long as it's, greater than half. Substantial authority falls below that. And so it literally is looking at the authority that supports your position and determining whether or not that authority is substantial. So in order to do that, you have to see what the authority opposing your position is. So you take a look at all of the authority that's in support of your position, and you look at that relative to any authority against it. So it's about 40%. So it's less than more likely than not. It's about a 40% chance that your position is right. Now, you can have substantial authority for multiple different positions, and that's why it's not like more likely than not, which is either it is or it isn't, because you could have substantial authority for a couple of different positions, but it's about 40%. Below that, if you've seen these terms before, just to put it in a bigger scope, realistic possibility of success, 33%, reasonable basis is only about 20%. So let's go to the next slide quickly, just to kind of talk about substantial authority. It really means all of the authorities that are relevant to the tax treatment of an item, and it also includes, like I said, the authorities that are contrary to that treatment. You take all of that into account to determine whether or not substantial authority exists. The interesting thing about it is it's an objective standard, and so you don't look to see what the taxpayer actually believed at the time, because it's not subjectively whether or not they thought the authority was substantial. It's just objectively whether or not it was. And so you could actually find authority that existed at the time later that the taxpayer didn't rely on that could still support a substantial authority argument, because it's whether or not there was substantial authority at the time, sort of regardless of whatever the taxpayer thought. There is substantial authority for the tax treatment of an item. It's measured at two different times, either at the time that the return is filed or on the last day of the taxable year. So for 2018, you would need to show that there was substantial authority either on 12/31/18 or let's say 4/15/19 or 10/15/19 if that's when you filed your return. If there's substantial authority, let's say you got audited in 2020, and you argue at the end of 2020, oh, here's some authority that supports my position. If that authority didn't exist at the time you filed your return, or at the time the year ended, then it's not helpful. It won't actually help you for your substantial authority. So we'll just take a look quickly at the next slide. It just talks about when we're looking at different kinds of authority, the things to consider. Are the facts on point to your situation? Is it just conclusory, or does it actually show the process of how they got to that answer? Was there anything deleted or redacted, which you'll see a lot of times, which might sort of water down the weight? What kind of document is it? How old is the document? Although sometimes you can have really great ones that are really old. And then what does the statute itself say? And then just really quickly, and then we'll flip to our last polling question. These are the different types of authority that are listed in the statute. Obviously, the Internal Revenue Code and other statutory provisions, all kinds of regulations, revenue rulings, revenue procedures. Again, certain of these obviously have more authority than others, and because you have to weigh the weight of your authority against the other ones, it's important to consider if all you have is an old revenue procedure, but there is a lot of regulatory, current regulatory authority that's against your position, that's not going to be very good for you. So let's take a break and do our next polling question, and then we will move on.
Right. Excuse me. All right. Okay. Just harkening back to one of the issues that David mentioned in the campaigns is have you or your company engaged in cryptocurrency transactions, or even if you plan to take part in this or start moving in that direction? We'd like to know about that. So, Ann, when you're talking about that list of authority and positions, you know, the 90%, 80%, 1 in 3 for or for a 1/3 chance or a slightly more than 50%, how do you decide you have reached that amount in those positions?
So basically you would look at, let's say you're taking a certain position for any item. You want to look at what authority exists out there that supports your position, either stuff, you know, hopefully directly on point, something analogous if there is nothing directly on point, but you can't ignore whatever is out there that is contrary. Now, that doesn't mean that you have to unearth every single potential contrary analogous situation in order to weigh it. It just means that you can't turn a blind eye to a case or a revenue ruling or something else that you take a look at that sort of indicates that your position is not going to be supported. So you sort of look at the universe of all the information and say, okay, I've got, you know, a couple of revenue rulings, several cases, and then this regulation that support my position. And then I have this bankruptcy case out of Alaska that seems to indicate something different. Well, your authority is substantial compared to this one bankruptcy case that's not presumably where you live. And so you weigh the two of them. If you're looking at, okay, well, I have older revenue rulings, you know, a few maybe tax court cases, but then there's like a couple of Supreme Court cases and a new proposed regulation that the IRS came out with that's contrary. That's going to weigh towards this other authority being more substantial than yours because it has higher authority. Supreme Court cases are obviously worth more than tax court cases, and regulations are going to be worth more than revenue rulings because the IRS can issue a revenue ruling whenever they want, and it doesn't have the same kind of rules as regulations do. Although proposed regulations obviously are a little bit more, a little bit less substantial because they haven't actually been enacted and gone through the notice and comment period. But you just sort of have to weigh it, what you can find out there that supports your position and then what's out there that doesn't support your position.
Great. Well, let's go ahead and move on and talk a little bit about, quickly walk through some of the updates that have happened on international issues, particularly on the reporting and alternatives that are out there. Ann?
Yeah, so there was another change with respect to the Form 5472. If you're familiar with that, it's an information return, and it's filed either by a U.S. corporation that's 25% foreign-owned or a foreign corporation that's engaged in U.S. trade or business. And previously, the penalty for either failing to file it or for filing it late was $10,000, and that penalty has been increased now to $25,000, which is a pretty hefty fine, especially because if you consider sometimes, you know, you've got multiple international information returns attached to your return, and if that return is late, we're now looking at $25,000 per form. So we don't have the new Form 5472 for 2018 filings yet. This won't kick in until 2018 tax years, so it'll be when these are filed next year in 2019. But we do have the draft instructions that the IRS has put out. And the penalty section is a little bit different than it used to be. There's now a warning of criminal penalties for the failure to file, which was not previously there. Now, that's not to say that they didn't exist, because, of course, criminal penalties for failing to file something, they exist statutorily. And so whether or not it says something about them in the instructions for a particular form does not dictate whether or not the IRS would have the ability to make an assessment for them. It was just an interesting addition because the $25,000 penalty is a civil penalty, and previously those two had been kept kind of separate. So the IRS is definitely starting to crack down on these. We've seen, and this segues into the next slide if you want to switch to it, we discussed back in June about how the Offshore Voluntary Disclosure Program was coming to an end. It did, in fact, end on September 28th of this year. It's not that the IRS thinks that everybody is compliant or that they don't want people to try and voluntarily comply, because, of course, they do. what has happened is the IRS has gotten a lot of different ways to get this information, and there were less people filing under the OVDP program, and the IRS had more ways to find people and to catch people outside of it. So it's actually that the IRS is more interested in this stuff now. So it's not like they closed the program down because they were less interested. And I think the addition of this, or the increase of the penalty, is just showing as well that they're more interested. So we talked about this quickly in June, so I'll just mention again, there are other programs that are still open, even though the OVDP has closed. There's still the streamlined compliance procedures, and then there's also the delinquent procedures, which can be used either for international information returns, like a 5472, or for FBARs. So those can continue to be sent in, and the IRS has given no indication. Those ones actually just kind of popped up one day into existence, so the IRS has given no indication as to when they might be stopped. But with the OVDP, we had, I don't know, a couple of months warning, but it's possible that these other procedures could go by the wayside as well, and that the IRS could start cracking down on a more criminal manner. And so they issued a recent memorandum. If you want to go to the next slide for 1 second, it just talks about what the new voluntary disclosure procedures are. And these ones, just to be clear, are similar for similar taxpayers under the OVDP, which is for taxpayers with exposure to potential criminal liability or really substantial civil penalties. So in all other cases, we can continue to use the other procedures. And I think we're going to learn a lot more about this, so we'll keep you up to date on these new voluntary procedures. But the memo that the IRS issued just talks about the way in which these are going to be routed. And it only requires 6 years of returns, which used to be 8 under the OVDP. So I don't know if you want to flip over to our last polling question.
Yeah, so we'd like your feedback on some topics we're thinking about for our mid-year update in the May-June timeframe. So let us know what you might be interested in, so that we can give you some information that could be helpful to you as you move forward in the calculations. So great. I think as we're coming to a close here, we really appreciate your participation today, and hope that you've gotten some information about what's happening with the IRS other than the guidance they're issuing on the Tax Cuts and Jobs Act. So thank you very much for your attendance today, and we look forward to talking with you and hearing from you again.